Higher inflation and market volatility has put some investors on the defensive. On today's show, we'll examine ETF strategies for buffering your portfolio with dividend income. Plus, we'll examine why value stocks could be poised for a major breakout. Lance McGray at Advisors Asset Management joins us right after this. Welcome to the program. I'm Arianne Alcorta with ETF Guide. Thank you for joining us. If you're new to ETF Guide TV, be sure to hit the subscribe button below. This will ensure you never miss any of our original episodes like Spotlight, ETF Battles, and other shows in our program lineup. We also encourage you to post your thoughts or questions in the comment section below. Now let's get right into it. Investors are on high alert due to stock market volatility and soaring inflation. Today, we will discuss how buffering your portfolio with dividend income could be one strategy for combating the challenging climate. Lance McGray is here with us to elaborate more on this. He is the head of ETF product at Advisors Asset Management. Lance, welcome.
Thanks for having me.
Since the start of 2022, we've seen a huge swing in market sentiment away from high-flying growth stocks into value stocks. And this changing sentiment has lifted the AAM and S&P 500 high dividend value ETF higher, and that's ticker SPDV. So Lance, how has the shift from growth stocks to value benefited SPDV?
Yeah, absolutely. It's definitely seen some large swings, right? Especially on a year-to-date basis. The impact of rising rates, potential inflation going forward has really gotten a lot of investors to start thinking about, should we be, heavily allocated into the growth-oriented area of the domestic equity market? And, what we've seen over the last few weeks, and, to be honest with you, the last month or so has been completely different than what we've seen, since coming out of the financial crisis. People are starting to worry about valuations. People are starting to worry about the impact of rising rates. And as you mentioned, inflation is here. So the last month or so has been a fantastic time for value-oriented stocks over their growth peers. If you look at some of the more broad-based indices, comparing the S&P 500 value index compared to its S&P 500 growth counterpart, the value index has outperformed it by nearly 9% on a year-to-date basis. And mind you, we're still in January. More importantly, if you look even at the underlying index of SPDV, which is the S&P 500 dividend and free cash flow yield index, that underlying index, which really focuses and really takes a focus on deep value securities that are offering high yield, but also have dividend paying companies that are producing a lot of cash flow, has outperformed the S&P 500 growth index by nearly 12%. So far in January or year to date. So it certainly appears that, there has, as you said, there has been a huge swing and investors, at least for the first part of 2022, have really migrated to sort of quality dividend paying stocks versus the growth oriented stocks that have really fared so well for the past decade. So regarding SPDV, SPDV is a very unique strategy. From a dividend perspective. And there's really two big components. Number one is security selection, and number two is the weighting scheme. So if we just look at the security selection, what really makes it different than a lot of the dividend and value products that are currently in the marketplace is that we look at not only valuation metrics, but we also look at dividend yield and we blend them together. So we're taking 5 securities from each of the 11 gig sectors that have the best combination of highest dividend yield and highest free cash flow yield. History has shown us historically that dividend paying stocks have outperformed those stocks that don't pay dividends over time. But also we know the importance of dividend sustainability and the ability for a company to maintain and grow its dividend over time. And that's why we really blend these two metrics together, these traditional valuation metrics together. So we're getting high dividend paying stocks, but we're also getting companies that have high free cash flow and have the ability to maintain and grow those. On the weighting scheme side, our portfolio is an equal weight portfolio. And really that lends itself well to the value-oriented goal of our strategy, because if you really think about it, a equal weighting scheme is really buy low, sell high. So not only do you get a security selection that is focused on value and dividend paying stocks, but you pair that with a weighting scheme that also accentuates, a value-oriented portfolio. And it's really, really a unique solution, which at the end of the day, you're looking at about 55 securities. You have a high dividend yield, which at 12/31 was about 339, and you have very attractive valuation. Some may even say it's a deep value strategy compared to its other, core value-oriented strategy. So a very, very unique product on the dividend side, which is something that we really strive ourselves on to help investors, help advisors meet their demand and meet their goals. And in this environment, a lot of investors are sort of migrating from growth-oriented stocks into value-oriented stocks and really looking for the buffer of a dividend-paying stock to help in this elevated levels of volatility that we've experienced recently.
Lance, and according to analyst surveys, the Federal Reserve is expected to lift interest rates 3 or 4 times this year. That's probably bad news for bond ETFs and funds with longer durations. On the other hand, the AAM Low Duration Preferred and Income Securities ETF, or commonly known as PFLD, is taking a unique approach to hedging against higher interest rates. So tell us more about it.
PFLD is, again, it's a very unique solution that we brought to market, and it's really created to meet the demand and help investors and advisors meet their income solutions, right? In this world, as you mentioned, with rising rates and the inflation, staring at us in the face, traditional fixed income products are going to essentially feel the wrath of rising rates, right? And that's, obviously rising rates is helpful from an income standpoint going forward, but it also has a negative impact on current fixed income portfolios. And as rates rise, prices decrease, and that is going to be a large drag on traditional fixed income securities. And for those investors that are looking for meaningful income, don't forget, the 10 years at 175 still today, approaching 180. We're still at historically low interest rates. And it's very hard to find meaningful income in this type of environment. So PFLD is a very unique solution. It leverages the benefits of the preferred market, which, have historically yielded higher rates than their traditional fixed income counterparts. So that is one true benefit of the preferred market, but also the diversification standpoint, the low beta, the low correlation to traditional bonds and fixed income, and also equity markets. So in this environment with heightened volatility metrics, the potential diversification benefits of PFLD can be very, very attractive. And then throw on top of that the fact that PFLD focuses on low duration preferred. So you're getting exposure to preferred securities that have an effective duration of less than 1. And what does that mean? That means if rates do rise, you are getting a very attractive income level, but you're not going to be as impacted by the rising of interest rates as if you were in one of the longer duration preferred products in the market, which generally come with a duration of around 4 or 5. So you're getting a substantial reduction in interest rate volatility. The 12/31 SEC yield was 526. And on top of that, nearly 60% of this portfolio is qualified dividend income, which means that you have preferential tax treatment on the income. You're getting a high level of income. You're getting an even higher level of after-tax income with minimal interest rate exposure, with the duration around 1.17 as of 12/31. So very attractive product in this environment, what I would call an alternative income solution for those that can't find the yield in traditional fixed income or equity products. And also, in the meantime, minimizing your exposure to duration risk or interest rate risk. So a fantastic product that's up over 1,200% over the last year in assets, and one that we think is going to be a very interesting solution for those investors looking for income and worried about rising rates in 2022.
Great. And Lance, earlier we talked about about high dividend value investing in U.S. stocks. But it's interesting to see how that same tactical approach seems to be working for international stocks. AAM offers high dividend value strategies on both developed markets, DMDV, and emerging markets, EEMD. What important trends are you seeing in foreign stocks?
Well, I think the first thing that we, as U.S. investors, domestic investors, the hurdle that we really have to get over is the home bias, right, of being invested, largely in the U.S. domestic market, and quite honestly, that has proven to be very fruitful over the last decade, in that U.S. domestic equities have performed relatively well. But from a diversification standpoint, we're seeing a lot of investors, a lot of advisors sort of dial down the exposure to U.S. domestic equities, and they're starting to look in international and emerging markets, mainly because of valuations. It's very attractive. There are pockets of the international exposure, international market, UK, Japan, some of the broad-based Eurozone countries that really have attractive risk-reward profiles, right? And we're going to be focusing on the same sectors that we're focused here on the U.S., right? Those value-oriented sectors that have really been beaten down. But we're also focused. We do believe as a firm that we're bullish on emerging markets as well, right? And we think there's a lot of upside in China. We do see high levels of potential return out there in 2022. But also, don't forget, we do expect to see a lot of increase in volatility as well around geopolitical issues. So to get back to your main question is, our high dividend value suite, whether you're looking for U.S. domestic equities, international equities, or even emerging market equities, if you're a believer in our common sense investment thesis or strategy that it pays to pay in high dividend paying companies that are generating high cash flow, that are attractively valued, you can carry that through the domestic equity market with SPDV. You can look into DMDV, which is our international equity portfolio, and EEMD as well. So again, 3 solutions, the same strategy, just different starting universes. The benefits are the same, a fairly highly concentrated portfolio of around 55 names, high dividend paying stocks, companies that are generating positive free cash flow, sector diversification across all 11 sectors. And also, don't forget, all 3 of these products also pay monthly distributions. So it provides the investor the ability to, 1, use that income on a monthly basis, or reinvest those dividends to really leverage the benefits of compounding of the dividends for long-term capital appreciation as well. So we do favor international and developed markets as well as emerging markets. We think it's an area that many investors should start to look at in 2022. And we're really optimistic about those markets going forward.
Lance, one final question before we take off. Inflation is something that financial advisors and investors are constantly trying to tackle. Now that the uptick in global inflation is here, why do you believe a dividend income approach is the right remedy?
I think the extension of what we've seen thus far in 2022 is going to continue. The fact that people or the investors are sort of pivoting from high growth oriented stocks, right, in the face of rising interest rates, in the face of inflation, right. Many investors are thinking about equity duration, right, which is the concept that rising interest rates will be headwinds for growth-oriented companies, right? The present value of future cash flows is really going to hinder those companies that are sort of being held up or propped up on future cash flows. So as interest rates rise, that is going to be a big headwind for growth-oriented stocks. And that is one reason why we're seeing a lot of investors sort of pivot and looking for high cash flow generating products, companies that have stable business lines, that are generating revenue, generating profit, and really creating cash flow, right? And that's one way to minimize your exposure to equity duration. Additionally, I think the consensus across the street is that gross margin should remain stable in 2022. Now, the likely outcome will be that corporate earnings may not outpace what we saw in 2021. So therefore, growth metrics might not be as strong. And if you take that one step further, the impact of dividend income, not only in the fixed income market, but also in the equity market, is going to be a major driver of total long-term appreciation. Or if you look at total return in 2022, it's potential that that dividend income is going to be a major driver of total return in 2022. So in the face of rising rates and inflation, we do feel that, high dividend paying stocks with positive free cash flow, attractive valuations are a very attractive place to be heading into 2022.
Thank you so much, Lance, for your insights. We have come to an end to this discussion, and we do appreciate all of your invaluable thoughts on here. Thank you so much for coming. To learn more about dividend income investing and ETF lineup at Advisors Asset Management, visit aamlive.com. The link is posted in the description section below. Don't forget to subscribe to ETF Guide TV. Tell us how you've been enjoying our timely programs like this one, along with ETF battles and many others. You can also find us on Twitter at ETF Guide. I'm Arianne Alcorta. Thanks for watching.